Hey traders, just wanted to share with you today a little hedging strategy I've been looking at this week, and it is a put ratio backspread in SPY. So you can see here we're selling the 325 put, and if we go down, we're buying two of the 295 puts. So selling the put here at 325, buying two here. So you can see we've got what I call a valley of death here, but we've got zero risk if the S&P 500 stays flat or goes up, even if it drops about 10% or so. That's at expiration, of course. This is our T+0 line. So you can see the stock will give us a little bit of protection if the market crashes. The max risk at expiration is just under $3,000. And if we change this and add a few extra lines, you can see how the trade progresses through time. So what we don't want to have happen is the market end down in this zone without an accompanying spike in volatility. It's a long Vega trade. You can see here we've got about 10 Vega, and that Vega will increase if the stock declines, which is good as well. If the market does drop, we're tending to see a spike in volatility and our Vega's increasing as well. So that can be good. So you can see you can lose a little bit of money at these interim dates if the market drops just a little bit, but what you'd want to see is a little spike in volatility as well. So let's say volatility jumped 10%. You can see that all those interim lines now get lifted up. So for pretty much zero cost, it's not zero risk, but for pretty much zero cost, we're getting some pretty decent downside protection, particularly if volatility spikes. As you can see, even if it spikes, a bigger sort of 20% now, all of a sudden the trade's looking a lot better down in this zone. So anyway, just wanted to share that with you. Not a trade recommendation, of course, do your own due diligence, but little interesting case study that we might watch along with, and might fill you in a few weeks to see how this one's doing. Have a great day. Talk to you soon.